You paid your car insurance every single month. On time. Every time. And the bank repossessed your car anyway. That is not a hypothetical. That happened to 25,000 real people, people who did everything right. Wells Fargo found 570,000 customers who already had car insurance and secretly charged them for a second policy they never asked for, never agreed to, and never even knew existed. Then, when the fake charges made their loan payments look late, Wells Fargo took their cars. This is how it happened, and this is how you make sure it never happens to you. Think about your own car right now. You have insurance. You pay it. You have the card in your glove box. You are covered. Now imagine opening your bank statement and seeing an extra charge, $100, maybe $200, just sitting there, attached to your car loan. No explanation, no letter, no phone call. You call the bank. They tell you it is for insurance. You already have insurance. You tell them that. They say they need proof. You send it. The charge stays anyway. Now your loan payment looks short because money that should have gone to your principal is being eaten by a policy you did not buy, from a company you never heard of, arranged by the very bank that holds your loan. Miss enough of those short payments, and they send a repo truck. That is not a story from 1987. That happened in 2016 and 2017 at one of the largest banks in America. And the reason it happened is a system built specifically to make money off of you quietly, without you ever noticing. This is not speculation. In 2017, a review commissioned by Wells Fargo themselves, conducted by the consulting firm Oliver Wyman, confirmed that 570,000 customers had been charged for auto insurance they did not need. The Consumer Financial Protection Bureau and the Office of the Comptroller of the Currency both investigated. The findings are in federal court records. The numbers you are about to hear came from Wells Fargo's own documents. Wells Fargo built a system that automatically added insurance to your loan and profited from every charge. When you take out a car loan, the lender requires you to carry full coverage insurance. That protects their collateral, your car. Standard, legal, makes sense. But Wells Fargo had a partnership with an insurer called National General, and they built an automated system. If Wells Fargo's software decided your insurance was lapsed or missing, it would automatically enroll you in a National General policy and add the premium to your loan balance. The problem? The system was wrong, constantly. Customers had valid insurance. They had sent proof. The software did not process it correctly, or it expired in the system before the actual policy did. Or there was a data entry error, and the charges went out anyway. The insurance they were force-placed into cost between $700 and $1,200 per year, added to monthly loan payments that customers had already budgeted. On top of insurance premiums, customers were already paying to their own providers. Some customers were paying twice for the exact same protection, once to their real insurer and once to a policy Wells Fargo picked for them. Here is what you do right now. Every 90 days, log into your car loan account and look at the itemized breakdown of your payment. If you see any line item for insurance, collateral protection, or force-placed coverage, call your lender immediately and send proof of your existing policy via certified mail. Keep the receipt. The paperwork trail is your only protection. Here is the number that should make you stop. 25,000 people lost their cars, not because they missed payments, because a software system added phantom charges until the math no longer worked. The customers least able to fight back were the ones most likely to lose their cars. Think about who does not immediately catch a $95 monthly overcharge buried in a loan statement. Someone working 2 jobs, someone who set up auto pay and trusts the number that comes out of their account, someone whose English is a second language and the fine print is dense, someone who does not have the time to spend 45 minutes on hold with a bank's customer service line. Those are exactly the customers Wells Fargo's system hit hardest. Of the 570,000 people charged, roughly 274,000 were pushed into delinquency. That means nearly half of the affected customers fell behind on their loans because of charges they never authorized. And of those, 25,000 had their vehicles repossessed. A car repossession is not just an inconvenience. For most Americans, losing a car means losing the ability to get to work, losing the job, losing the apartment. The damage from a single wrongful repossession can take years to recover from, and it hits a credit score the moment it posts. Wells Fargo collected fees on those repossessions too. If you have an auto loan at any major bank, not just Wells Fargo, set a calendar reminder every quarter to review your full loan statement line by line. Insurance add-ons are not always labeled clearly. Some are buried under terms like ancillary product fee or product protection charge. Wells Fargo's own consultants flagged the problem. The bank sat on it. The Oliver Wyman review was not ordered because Wells Fargo customers were complaining loudly. It was ordered because the bank's own executives had internal concerns about the program. And when the review came back in 2016 and confirmed that hundreds of thousands of customers had been wrongly charged, Wells Fargo did not immediately stop the program, issue refunds, or contact regulators. They spent another year and a half continuing to run it. The fake account scandal broke publicly in September 2016. The forced auto insurance story did not become public until July 2017, when the New York Times published an investigation based on the Oliver Wyman report. For at least 12 months after internal confirmation of the problem, customers were still being charged. Cars were still being repossessed. This matters for one reason. The cover-up tells you that the original system was not a mistake. It was a product that generated revenue. And when it was found to be fraudulent, the first instinct was not to fix it. It was to contain it. Never assume your bank's automated systems are working in your favor. They are built to optimize revenue, not accuracy. You are the quality control. Wells Fargo paid $385 million. The average customer got back less than the cost of 1 month's worth of wrong charges. In 2018, Wells Fargo agreed to a $385 million class action settlement covering the force-placed insurance victims. Sounds large. Do the math. 570,000 customers, $385 million. That is roughly $675 per person before legal fees, which in class actions typically consume 25 to 33% of the total fund. After fees, many affected customers received checks between $100 and $400. The people who had their cars repossessed were eligible for additional compensation. But collecting it required filing claims, providing documentation, navigating a settlement process, and many affected customers either never heard about the settlement or could not gather the required paperwork. Meanwhile, the Federal Reserve imposed a growth cap on Wells Fargo in 2018, limiting their total assets as punishment for the broader pattern of consumer abuses. That cap remained in place until 2025, 7 years. The fine the bank paid was real. The accountability was partial. The lesson is this: class action settlements pay lawyers. They compensate victims imperfectly. The only protection that works is catching the problem yourself before it reaches repossession. We started with a simple fact. 570,000 people had car insurance, paid it every month, did everything right, and a system built by their own bank added a second bill they never saw, pushed their payments into delinquency, and repossessed 25,000 of their cars. Not a scam from a stranger, from the bank holding their loan. Here is the one thing you do after watching this. Log into your auto loan account today. Pull up the full payment history. Look for any charge that is not principal and interest. If something is there that you did not authorize, start the dispute process today in writing. The bank's system is not your friend, but now you know how it works. If this video changed how you look at your car loan, that is the whole point of this channel. Subscribe.